People, good morning, good afternoon, good evening, wherever you're catching this channel from. So today I'm just going to quickly have a look at some of the trading mistakes that price action strategy traders do. And it's just going to be a very short video. I'll first of all just try to highlight it from here, the way you're seeing it on this chart, and then I'll try to see if at all we can see these places directly from our live chat. So number one, or one of the reasons that price action traders make is having unrealistic target. We all know about this ratio that we always say that a good trade should be one, which has 1 to 2 return to investment, or ratio, which means if you are willing to lose 10 pips, for that trade to be a good trade, you should be able to gain more than 20 pips. So that is 1 to 2 ratio. Or some people love to hold on to trades until they do a 1 to 3 ratio. But then you find that some people will enter a trade and have, let's say for example, like this one, you'll enter a trade from here. Let's say one will enter a trade, I'll put this one out, one will enter a trade from here expecting that this market trend to come back all the way up to here. You see, this is what we call unrealistic target, because what this market has done, and if you look at it, and mostly that's why I love looking at the market from a higher time frame, because the higher time frame helps you to predict or know the market trend. So somebody who entered this trade here for a sell automatically was taken out from here when the market reached here. The price action reached here and the market reversed and continued going upwards. Because why did it reverse? Because if you look at this trend from a higher time frame, this market is on an upward trend. And as they say, if the market is on an upward trend, you as a trader, the worst thing you can ever do is try to get into a buy. The same way the reverse is true, that if the market is on a downward trend, then you'll be jeopardizing yourself if you try to get into a buy when the market is on a downward trend. So that's one of the reasons why traders lose money, because of price action, and one of the mistakes they make. Number two, another mistake that traders who use price action make is they love putting their stop losses near the entry. I'll give you a good example. So let's look at this trade here. If you look at that trade here, this person, let's say, would have entered the trade from here as for a buy as the market went upwards. But then the market reached here, which was a point of resistance, and immediately, when it reached there, immediately the market reversed. So when the market reversed, look, if somebody had their stop loss just next to their entry, it means this person would have been taken out of this trade. So this is one of the reasons why one of the mistakes that traders who use price action lose money on the market. So we should be very careful when we're entering trades to avoid just putting our stop losses near our entry point, because it helps you, especially during reversal, for you not to be taken out. I know of some people who use, there are people who will use Fibonacci retracement tool. So like, for example, if you enter the market from here, if this is your retracement tool, there are people who will maybe want to put their stop loss either here or here, just to avoid being taken out of the market quite soon. I've known other people who use pips, others will use maybe 50 pips, others will use the ATR indicator, just to be able to determine what is the exact place to put a stop losses. There are other people who use support and resistance level, and support and resistance level are just the same as the Fibonacci retracement level. So That is the mistake number 2 that traders make using price action. Mistake number 3 is at times, what at times traders, what they also do is having their take profit level just above above just the entry level. So like, for example, or you can call it trend continuation. Like I was saying, if a person entered this trade from this level, he would have held this trade all the way up to here, you know. But what that means is, if you look at the market from a higher time frame, because if you're doing your analysis, you look at the higher time frames to be able to understand what is the trend of the market, and then you come back to lower time frames. So for example, if you're trading on a 4-hour time frame, you like to look at 30 minutes or 1 hour for you to get your entry levels. If you're trading on 1-hour time frame, you like to look at 15 minutes or even 5 minutes time frame for you to get to your entry level. But for you to know exactly what is the trend of that particular market or that particular pair that you're trading, then it's good to always look at the higher time frame, because it will help you know the market trend. So this person who put his take profit level here, he would have just held this trade and continued and gained all the way up to here. So that's another mistake that price action traders make, by not looking at the trend continuation, or not following the trend, or not being able to look at the higher time frames to know where the market is headed. The last one that I'm going also to look at is entering trade away from the value area. And by value area, when I'm talking about value area, it means if you look at the chart, there are specific value areas that you're going to have. So like, for example, if you're looking at this place here, this will be a liquidity zone. A liquidity zone is an area whereby the market starts from there moving up. This will be another liquidity zone. Yeah. At times on the market, we'll have market gaps. So when I'm talking about this, I think it's fair enough just for me to move onto the market chart so that you can be able to identify this area. So like, for example, this is 4-hour time frame on AUD USD. Let me just try to check if at all there are better areas that I can get, or let me try another pair. You see if you can get, let me say this. Yeah, this will do. So I like to use here, so let us identify those value areas. So value areas, for example, I look at, this is a value area because this is the liquidity zone. When the market was going up, so many people will leave their stop losses here. When the market was going up, this was also another area of market value. So I like to call this this is a trade imbalance, or the market left a gap. So this will be a liquidity zone. So I'll mark it as a liquidity zone. Let me just put the text at the bottom so that you can look at it clearly. So that will be a liquidity area. Another liquidity area, if you're looking at the market, let me just remove this and remove that just for the purpose of demonstration. One thing we are seeing here is we are seeing a trend line. Let me draw the trend line properly. We are seeing a trend line. I'd like to use that. So there's a trend line from here. You see how the market is respecting that line. So what I mean by the market is respecting this line is, it's a trend line. The market reaches here and it bounces back. It reaches here, almost touches the place, and bounces back. Reaches here, almost touches the place, and bounces back. So when you enter this trade away from these value areas, another value area maybe will be here. This is another liquidity level. So liquidity level, we look at these areas. So another liquidity zone. So if you have entered this trade, so for example, when you entered this trade, let's say you entered this trade maybe here. because this is the liquidity. This is the liquidity zone. If you entered into this trade maybe away from this level for a sell, maybe here, it means you'll not be able to get much out of the trade, because this is too far away from the liquidity area or value area. The same applies to this gap. Someone who entered this trade, let's say from here, this is too far. Someone who entered this trade, let's say from here, because if this was the gap, if that was the gap, someone who entered this trade, let's say from around here, it will have taken them a long time for them to reach the value area, which was this market gap. You understand? Because this is on a 4-hour time frame, and for this trade to move from here to come and fill this market gap, it takes almost 414 pips. And if you're trading on a 15 minutes time frame, to cover this 114 pips, that will take you a lot of time to be able to cover that market gap. If you move from here to here, 14 pips, if you're trading on a smaller time frame, it will take you a lot of time to cover the market. The same way it applies to this one here. So this liquidity zone, someone who entered, let's say for a buy from here on a smaller time frame, from here, and would want to hold this trade all the way up to here. Remember, what happens is this market came up to here and it reversed. If you move this on a slower time frame, this will be a lot of pips on a smaller time frame than compared to a 4-hour time frame or daily time frame. So those are a few mistakes that traders always make when they're using price action. And the best way is to always enter a trade if it's near if it's always near the market gap or the value places. And I've mentioned the value points or the value places are liquidity zones, if you have market gap or imbalances, or near the trend line, because if the market has to break this, we call it break of structure. So if the market has to go below that, that's break of structure. Or if the market has to go beyond this liquidity zone, it means it's break of structure. So if I'm looking at market breaking the structure and going past this level, it means I can enter this trade maybe from here. You understand? So there's that level where there's an order block. So if I enter next to the market structure, what the market does, it came, checked out or broken the structure, retested and went all the way up. So those are the few mistakes that traders make when they're using price action. Thank you so much, and for more price action and smart money strategy, please like this YouTube video and subscribe to my page so that every time I upload a new video, you should be the first one to get notified. Thank you, and bye-bye.